Not a day goes by that I don't have an in-depth conversation with someone about their retirement and future. Here's how most of them go. I'll say, "You're in great shape financially." They'll reply, "I am." And I'll reassure them, "Yes, we've discussed this before. You're in great shape financially. You could afford to spend more money." But they just look at me like I've grown a third head. Sadly, more often than not, they go right back to the same habits, avoiding the idea of spending, even when they don't need to. And I get it. The psychological barriers of spending your own hard-earned savings, it can be overwhelming. That's why in this video, I'm going to dive into 3 common reasons why people hesitate to spend in retirement. Then I'm going to break down the spending strategies Vanguard recommends to help you find a balance between enjoying your retirement and ensuring that your money lasts. Then I'll show you the best way to ensure that you spend more when you're younger and healthier. Welcome to the Retirement Guide channel. I'm Daryl Rosen. My firm, Securement Wealth, helps people all over the country plan for and hopefully enjoy retirement. If you have comments or questions, you know where to put them. If you want a flat fee Securement review or some help via hourly consulting, click the link in the description. I appreciate you watching. Well, for many retirees, spending the money they work so hard to save can be surprisingly stressful. Here are 3 common reasons why, with some examples that might sound familiar. This is the biggest worry for most retirees. With healthcare costs and rising inflation and unpredictable markets, it's easy to feel anxious. I mean, imagine you've saved for decades and then a big medical bill or a stock market decline happens early in retirement. I've had clients say to me, "What if I make one wrong move and end up broke?" And this fear can make retirees spend far less than they actually can, even when they have enough to live comfortably. Think about it. You've spent most of your life being told to save, 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 skipping vacations from time to time, cutting back on dining out, budgeting. All this became second nature. Now retirement asks you to do the opposite, to spend that money. And for many, that feels wrong, irresponsible, even though the whole point of saving was to use it one day. Breaking free from the saver's mindset can be very difficult. Many retirees feel guilty about spending money on things like travel, hobbies, or even small pleasures. There's thoughts like, what if I need this money later, or shouldn't I leave more money for the kids? These kinds of things hold them back. And while not everyone feels this way, especially about leaving money to the children, I've heard from many people who struggle with guilt, and it can steal the joy and freedom retirement is meant to bring you. For instance, you might skip a dream vacation worrying it's wasting money, even if your finances are solid. Or maybe you delay something you've always wanted, like a swimming pool. One of my clients dreamed of a pool, but I had to practically beg her to go for it. These feelings of guilt can overshadow the real purpose of retirement, enjoying the life you've worked so hard to create. The key is having a plan that balances the 2 goals: supporting the lifestyle you want in retirement and ensuring there's enough left for the future, including any money you want to leave for loved ones. So here's the thing: with a clear strategy, you can spend with confidence and truly enjoy the years you've worked so hard for. So let's look at withdrawal strategies that Vanguard suggests to their millions and millions of clients to help you achieve both goals. Later on, I'm going to take you right into my spending software to show you how I create a spending plan with my clients that allows them to spend more when they're younger and healthier, because that's the goal. The bucket withdrawal strategy divides your retirement savings into 3 buckets. There's short-term, intermediate term, and long-term. The short-term bucket should contain money you'll need to live on for the next 3 to 5 years. So you need to consider investing this money in traditionally safe or liquid assets, cash equivalents. Rates are still pretty good in short-term bonds. The intermediate bucket should contain money to cover expenses for the next 5 to 10 years. So we want longer-term, perhaps high-quality bonds, REITs, stocks, including utilities, for this type of investment. And then when we get to the long-term bucket, we should hold investments that will continue to grow throughout your retirement. This is where you want your highest concentration of stocks and that. The pro of this strategy is less risk because you're going to have cash on hand and may not need to sell stocks or tap into other accounts in the event of an emergency. Another pro is you should feel more confident knowing that you'll have certain assets and income sources set aside for anticipated future expenses. The con is you may not have enough for the retirement you envision, especially if you're overly allocated to conservative investments. We always have to watch out for that. With this, there's also the risk you outlive your savings. Now, there's another way this strategy falls flat. It helps you bucket where assets should be, but it doesn't really help you specify your spending number. The 4% rule is a popular example of the dollar plus inflation strategy. Here's how it works. You withdraw 4% of your portfolio in your first year of retirement, then each subsequent year, the amount you withdraw increases with the rate of inflation. If you don't expect your expenses to change much throughout retirement, this strategy can help ensure that you'll be able to cover your yearly costs for as long as the portfolio lasts. That's certainly the first goal. Also, if your expenses don't change much throughout retirement, the strategy seeks to enable you to cover your yearly costs for as long as the portfolio lasts. It could be best for you if your main priority is maintaining a steady level of spending from year to year. Here's the con. This strategy ignores market conditions, so you could end up running out of money in down markets or spending much less than you can afford to, certainly in up markets. Here's another major downside: the risk of spending too little early in retirement, only to find yourself in the regret zone later on, a point where you realize that you could have enjoyed more of your money, but you're no longer healthy enough to take full advantage of it. So as the name implies, a fixed dollar withdrawal strategy involves taking the same amount of money out of your retirement accounts every year for a set time frame, then reassessing. This strategy as a pro can provide a predictable income stream, which can be helpful for budgeting and planning. You'll know exactly how much money you'll be withdrawing each year. Another pro is simplicity. Fixed dollar withdrawals are relatively easy to manage, and you don't need to constantly adjust your withdrawal amounts. But it does leave you exposed to the risks of inflation. This is the winner. Vanguard calls it dynamic spending. The reason it's a winner is it combines the best of all the different approaches. You decide how much to withdraw from your investment portfolio each year with an annual spending floor and ceiling to help you stay within an appropriate range. This allows you to adjust withdrawals based on market fluctuations. You're taking more in years when the investment returns are higher and less when they're lower. You adjust your spending if and when your investment balances fall below a certain amount. So the main pro to this is as your circumstances change, you have flexibility to adjust your withdrawal amount, which may help your money last throughout retirement. This approach dovetails into how I do things with my clients regarding spending. I think life is all about adjustments, and spending in retirement really should be no different. The question isn't, can I spend this amount per year in retirement? It's how much spending will my resources support? Once again, the idea here is to avoid the dreaded zone of regret, where you realize you could have spent more, but because of health or other considerations, you're no longer able to. So let's take a look in the software at how this works in practice. This is a plan for Tim and Tina Sample. I know, very original. Tim is 64, Tina is 62. This is a program I use called Income Lab. And the whole purpose of this program is to help me help my clients get them to spend more money and to show them that spending in retirement is about adjustments. It's not about a preconceived notion about what you think you can spend. It's more like, what can your resources support? Tim and Tina want to retire in a couple years. Let me show you some of the inputs so you know what we're working with. This is $500,000 in tax-deferred assets. And we're going to look at Social Security. $32.92 is the primary insurance amount or full retirement age benefit for Mr. Sample, Mrs. Sample $28.50. And then they also have a couple other streams of income. Tim's got a pension of $585 and Tina's got an annuity for $697. So that's what we're working with. There's nothing here in the expenses tab because we're not going to put in a number like $5,000 a month or something like that. We're going to let the system determine where their spending should be. We can always make adjustments from there. This is the dashboard, or the 30,000-foot view of what they can spend in retirement. You see this as spending capacity. What this is telling us is how much the resources can support in terms of monthly spending. $9,800 a month, and that's a gross number. Now, if I come over here, I can show you that we can make a lot of different assumptions that will affect their spending capacity. I want you to think about that term, spending capacity. It's a big one. We can say that Tim's IRA is conservative, moderate, aggressive. I chose conservative because most of my planning, I try to be conservative with my assumptions. And then we also can do the same thing for Tina's IRA, same thing. In this case, I have hers being moderate to show a little bit of variation. We also can have what we would call an income setting, and I'm going to show you more about this. What this is suggesting is that we want the lowest possible chance, or at least a moderately possible chance, of having to make an adjustment in spending. Notice I'm not talking about running out of money. That's not really a consideration here, unless there is really a tragic health event that happens later on in life, which we can actually cover through long-term care insurance as a subject for another video. But in this case, what I want to see here is Do I want a greater chance of making an adjustment in retirement or a smaller chance of making a spending adjustment in retirement? And I'll get to that in a second. And there's also longevity. What we're suggesting here is they plan to live longer than 60% of the people in their age. And I can move this around too. All of this gives me a number, and the number here is $9,800. Now, this is the part where we get sort of into the dynamic spending, and this is akin to what Vanguard is talking about. This says that if the balance of the asset accounts reaches $613,000, then we can increase our spending. If the balance drops below $451,000, we need to decrease our spending. And if I come in here, I'm going to show you something that's really neat. You can see here there's an upper guardrail and a lower guardrail. And to the extent that I move around some of the assumptions, I'm either going to make that gap wider or more narrow. So let me show you what that looks like. The neat thing is we can play around with this slider down here on the bottom here. So you see $9,800 is that spending number we talked about. The lower guardrail is $451,000. What that means is that if the balances in your investment accounts go lower than $451,000, we may have to make an adjustment to our spending. So let's move this over here. Now I want to show you a couple things. This went up to $471,000, which means that we are now willing to accept a higher level of having to make a downward adjustment in retirement to our spending because of that. If you look here, this is $10,066. We go back here. This was $9,800. So we went up $250 a month. What we're saying again, if our investments are doing well, or if we're willing to accept a greater chance of having to make a downward adjustment to our spending in retirement, we can spend a little bit more. $250 more a month in this case. So that's really powerful to me. This is why I say that retirement is about making spending adjustments. To the extent we're staying within these guardrails, then we're going to be okay. Let me show you a few other things before we wrap up this video. This is a retirement stress test. And what I've done is I've said, how will this plan behave if we have a situation like the global financial crisis of 2007 to 2009? So here you can see the balance in the guardrails. The green shaded area is obviously where we could spend a little more money. The red or the pink shaded area is where we would spend less. And you can see that solid blue line is in between the two lines. And to the extent that were there times when we might have to make a downward adjustment to spending in our plan, we got close after the Great Recession. You can see on the bottom here, it puts this thing to the right here. It's kind of annoying, but you can see here that we're very close to the lower guardrail. The balance is $356,000, lower guardrail is $355,000. So we almost had to make a spending adjustment. Then throughout this other period of time, we were fine. See, we're staying within those two lines. As the market improved, we were actually up near the top of the guardrail, which would indicate maybe we could spend a little more money. And you can see over here, when we got into the bear market in the last couple of years, we almost had to make a spending adjustment downward right here in this area. So overall, this plan was pretty good at the spending level, which happened to be more than the client expected they could spend. I want to show you one other thing here. Let's go ahead and test the plan. Now, this is different from traditional Monte Carlo analysis, which is designed to say, will your money last? This is more about what are the chances we're going to have to make an adjustment to our spending? And we're mostly concerned about the downside adjustment or spending. Here's what this is suggesting. In 91% of the cases, the scenarios are above plan, 9% below plan. So what this is suggesting is there's a very small chance that we would have to make a downward adjustment to our spending given all the assumptions in this plan. So that's a bit of a pull back the curtain on how I look at spending with my clients, all with the hope of helping them spend a little more money when they're younger and healthier. In this case, these people wanted to spend about $8,500 a month. But once we did the analysis, they felt comfortable upping that by $1,000 a month, which is a lot. Could be meals with the children if they're nice to you, or additional spending on vacations or travel, or whatever makes you happy at that point in your life. If you have questions about the flat fee securement review or any of the services that I offer on an hourly basis to help you feel more certain about the future, slap my digits, as the kids say. If you liked this video, you might like this one or this one. And thanks for watching.